money. I think you just maybe one extra little piece of introduction. John is not only a member of the meeting in Ohio, but he's also been collaborating with the Quaker Institute for the Future for a while. They hold, well, he perhaps will explain a little bit more, but they have annual meetings where they dig into topics. And a few years ago, they started digging into the topic of money. And John is convener of a small circle of discernment that came out of that earlier discussion. And that circle is in the process of finalizing a book on money. So I guess that, in part at least, what John will be talking about this evening. Over to you, John.
Thank you so much, Ron. Well, first, let me explain to you how I ever got involved with this topic. About 15 years ago, I was retiring from teaching and research in physiology at Ohio University in Athens, Ohio. An acquaintance came down from Cleveland. Greg Coleridge is his name. And he was at the time working with the American Friends Service Committee in Northeast Ohio. And I got in a conversation with him after his talk. And he asked me, well, how is our money created? And I hadn't given any thought to that. I was in physiology. And I said, well, I don't know, but surely the government creates money. And he said, well, no, the banks create money. And I said, how could that be? Banks are private enterprises. Wouldn't that be counterfeiting? Well, anyway, he was right and I was wrong. And that led to exploration on my part in the last 15 years. And I've gotten into the educated through the American Monetary Institute and the Alliance for Just Money, two organizations in the United States that are interested in reforming the monetary system. So we think a lot about money, of course. We think about how to use it. We think about it as individuals. We think about it as families, businesses, and other organizations. But in all of this, we're thinking about using existing money. Those are fiscal issues, how to use existing money. But today I'm going to be talking not about fiscal issues, but about monetary issues. Monetary has to do with the creation of money and the maintenance of the money supply in society. So this business about what to do with existing money is certainly important. Our decisions really constitute where our values meet the rubber of the road of living in society, how we spend our money. But that's not my topic today. Okay, so let me also add, this may seem like an odd time to be discussing this as the government in Washington is shut down and possible global calamities lurk around us, environmental degradation leading to another mass extinction possibly, social and political chaos and economic depression from the collapse of our house of cards financial system. But day by day, we all move on, hoping to help society change its course before falling off one of these cliffs, or if it must be after, when we will be picking up the pieces. Now, in 2009, Peter Brown and Jeff Garver published a book called Right Relationship, Building a Whole Earth Economy. So what I want to do today is to look at the possibility of right relationship within the monetary system, within the system that creates our money and maintains the supply. Now I'm going to share the screen if I can to show some slides here. See if I can do this. All right, here we are. Okay. Okay, I'll go here. Show the current slide. Okay, so I'm going to start with just talking about the basics of how the monetary system works, so we're all on the same page. So the money supply, as you all know, consists of bills and coins and money in accounts. And the money in accounts then exists only as computer entries. It has no corresponding physical tokens. And that money in account comprises 95% of the total money in circulation, at least 95%. Some estimates are quite a bit higher. So that total amount of money in the account money grows continuously. Secondly, all account money is created by lending by private corporate banks. Loans increase the money supply. Every loan made increases the money supply by the amount of principal. Repayments decrease the money supply. So without continuous lending by banks, the money supply would be drained by repayments. Without debt, we have no money. Now, the US government does create money, but only by coining it. And the minting of coins provides a revenue source, a very tiny one. However, the government gets no revenue from printing dollar bills. It costs 9.4 cents to print a $100 bill, but the bills are sold to banks at the Federal Reserve banks for the cost of printing. That's in the United States. It's a little bit different from that in Britain. But anyway, this basically represents the monetary system then. So the banks create the loan, create money by lending money, and those loans go to people and to businesses and to governments. And there it circulates in the economy through the normal commercial pathways. And then each one of those borrowers, people, businesses, and governments, have to pay those loans back to the banks along with interest. So that's basically the money system. And you may notice the absence of any central bank in this. And in the United States, for instance, we had this money system going long before the Federal Reserve or central bank was ever created. And what the central bank did was essentially add another bank to provide some backup as needed for banks when they got into trouble. But it didn't change the fundamentals, namely that it's the banks that are creating our money as they make loans. Okay, now let me just pause here. I'm always interested to find out whether this information is new information or whether this is information that you are all familiar with already. So is this information about how our money supply is created and maintained? Could I ask a show of hands for those of you for whom this is new information, like it was for me 15 years ago? Is this new information? Yeah, I see a few hands going up. Right, okay. In many groups, not as sophisticated as yours, apparently. This is new for a whole lot of people. So let me say something about the distribution of wealth and power, and I'm going to go back to screen sharing again. Okay, and I want to go. Well, I want to advance there. There we go. So wealth and power are linked, as you all know. They're sort of two sides of the same coin. And what we are seeing today is the strangling of democracy by extreme wealth concentration. Let me say that again. What we're seeing today is the strangling of democracy enabled by extreme wealth concentration. Wealth concentration, of course, occurs legitimately in a well-regulated marketplace. But to prevent extremes of wealth concentration, there must be other processes to counteract it. These include giving, as in philanthropy, sharing and interest-free lending within families and community groups. But social policies are also needed. And these might include periodic debt forgiveness, as was practiced for at least 2,000 years in Mesopotamia in the Bronze Age, and which found its way into Mosaic law in the Bible as the Jubilee year. Effective antitrust enforcement in the marketplace could also temper wealth concentration. And progressive taxes, like we had back in the 50s, served to counteract extreme wealth concentration. And the monetary system itself could counteract wealth concentration instead of aiding and abetting it as it does today. So these various social policies, I'm just going to be talking about the monetary system. So let's look at the consequences of the current monetary system. And there are two fundamental ways that are listed here. One, it concentrates wealth, and two, it's unsustainable. So let me talk about each of these for a little bit. So how does it concentrate wealth? Well, it concentrates wealth by the virtue of the fact that we are paying interest. We are paying interest on all of the money in circulation because all of it has essentially been generated by loans from banks. This is an enormous flow of money. And it explains why banks have always been one of the most profitable entities in our commercial system. So this is a flow of money from the many, that is to say the users and the borrowers, to the few, namely the lenders. Secondly, the patterns of bank lending contribute to this concentration of wealth because they are more likely to lend to those who already have money. It helps a lot to have some collateral to put down for any loan from a bank. And thirdly, the system is intrinsically unstable. And its intrinsic instability gives rise to these booms and busts that have characterized the system for hundreds of years. And these booms and busts both serve the wealthy. The wealthy do very well during booms, and some of the rest of us do okay too. But then when the busts occur, the wealthy do okay, and they are in fact able to profit by buying assets from people who are forced to sell because they need to sell in order to cover their daily expenses. So this is another pathway of wealth concentration by this system. And let me say that in their 2009 book, Peter Brown and Jeff Garver noted that the global community has focused on poverty reduction, which is certainly essential, but has made no attempt to address excessive wealth and overconsumption. It must be addressed. The system is unsustainable. Our system of money creation requires continuous economic growth for its limited stability. Economic growth means continually increasing rates of consumption of resources and production of wastes, which is incompatible with continued life as we know it on a finite planet. Pamela, who's with us today, summarized it very nicely in her book, Money and Soul. She said, since most of our money is created through interest-bearing loans or debt, more money needs to be continually made in order to pay off the interest on that debt. To create demand for a growing market, more people need to be steadily convinced that they need more things. Thus, the requirement for economic growth is baked into the system. I could stop there and ask if there are any comments or questions at this point before I go on to briefly sketch out some alternatives. Well, hearing none, should I proceed?
I had a question about the
Okay.
instability. Why is that in a nutshell?
In
Why
a
are there
nutshell,
booms and busts?
sure. It's important to understand that. And booms occur when things look good. That is to say, when borrowers think they can borrow, expand their business, and have a market, an increasing market. And banks are always eager to loan. So when there are borrowers willing to borrow, the banks are eager to loan because that's the way the banks make their money. Okay. Now, what happens though is always, and as this has cycled through history, then the lending gets more and more eager, let's say. So increasingly risky loans are made by lenders. This happened, for instance, after the 2008 crash, when housing, because housing had gone into lending in the subprime market. That is to say, lenders were lending to people who they knew wouldn't be able to meet the requirements of the payback. So then, when payments begin to repayments of loans begin to fail, then people get scared. Businesses who may see their market decreasing, worry about taking any more loans, taking on any more debt. And banks become less willing to lend because they see this sort of tipping downward trend of the economy. So both of those phases, the boom phase is self-reinforcing. It's a positive feedback cycle, because as things get better, people are more willing to borrow, and banks are more willing to loan. But then when it begins to tip, it's also a positive feedback cycle that borrowers are less willing to borrow and unwilling to repay their debts, and banks are become much more cautious about lending. Does that help, Rory? Okay, good. Okay, let's move on then to some alternatives. And I'm going to talk about one rather specific proposal that's in this country, and two other general categories of proposals, both of which are mentioned in your document, Values, Principles, Policies, and Practices. So I'm going to talk first then about this proposal that has come out of the monetary reform awareness that arose in the 1930s during the Depression in this country. And a prominent economist at that time had proposed essentially shifting control of the money system from the private banks into the public arena. And that thinking then matured into a piece of legislation that was introduced into Congress back in 2011 and 12. And it has now been updated. That piece of legislation has been updated by the American Monetary Institute and the Alliance for Just Money. And it has not been introduced into Congress yet. We're still working on that. So that piece of legislation provided a full transition to public money. Money creation would be done by the government, guided by a high-level public entity whose sole function would be to advise Congress as to spending rates and patterns that avoid unacceptable levels of inflation or deflation. And the government would no longer need to borrow, so its debt wouldn't rise because it would be creating new money to meet its needs. Spending would be partially decentralized by distributing at least 25% of new money to states for social and physical infrastructure development. Banks could continue to lend, but in the same way the rest of us do. They would lend pre-existing money, not money they created. The payment system, our transaction accounts, that is to say our checking accounts, would be totally separate from bank lending, totally insulated from the risks of lending, providing stability with or without growth stability that's lacking in our current system. This next figure shows the contrast between that kind of proposal and the present system. And here you see on the right the present system with money created by bank lending. So it feeds money into the system. Here's the economy where it circulates, but it's given conditionally on being repaid. So here's the debt being repaid, the payments back to the banks, along with not only the principal but the interest, which is really interesting because what you can see here is the system is designed for the banks who provide our money to take more out than they put in. How can that even work? Well, it can work only because the rate of lending continues to exceed the rate of repayments, of sum total of repayments. And that's part of the demand for growth that's built into the system. So here money is created as debt, as a public liability. On the other hand, if the money were simply created by the government and spent into circulation, which is in effect what government does with coins now, they create the coins, they make them available to be spent into circulation, and they circulate forever as long as the coins last. Okay, so the money that was be created by the government would stay in circulation. Some portion of it would, of course, have to be taken out as taxes in order to provide the revenue for government to do the things that governments do. So here money is created as money, and it's as a public asset, not as debt. Let's turn our attention now to these other options. Let's talk about public banking, both locally and nationally. The public banking movement in the United States seeks to have municipalities and states establish their own publicly owned banks. And one state does have a bank already. It was founded back in the early 1900s, and that is North Dakota. Public banks would allow local government funds to be deposited in their own banks instead of being sent off to Wall Street or London. The banks would lend to projects of public benefit, either directly or possibly indirectly through private banks within their jurisdictions. The profit from lending by public banks would help fund local governments. This would shift some money creation from the private to the public sector, but it would leave commercial banking and the payment system unchanged. Money would still be created as debt. It's interesting that the German system of Sparkassen, Landesbanken, and Förderbanken has components of public banks. Now, the global movement towards central bank digital currencies would convert central banks really into public banks. Again, shifting at least some money creation from the private to the public sector. Specific proposals vary. One version, called retail CBDC, central bank digital currency, would allow all transaction accounts, that is to say our checking accounts, to move from private banks to the central bank to achieve a uniform payment system independent of the banks. But as these accounts move, bank lending, which currently depends on deposits, would slow down and potentially cease unless central banks decided to lend to commercial banks to maintain their deposits. Now, if private banks continue to lend with that central bank support, the central bank could impose conditions, channeling that lending into projects of public benefit. So this is called credit guidance. That is a guidance offered by the central bank as to what banks can do with the money that the central bank has loaned them. Now, if on the other hand, the central banks fail to provide that support for private bank lending, commercial bank lending is cut back, central banks would have to step in to initiate other lending simply to maintain the money supply. But either way, the payment system would be separated from bank lending, eliminating bank runs and minimizing these economic oscillations of booms and busts. through appropriate central bank lending policies. One motivation for central banks to issue CBDCs is that the central bank could offer the advantages of digital currencies to users that would be backed by the security of national governments. They like that idea because that would, in their view, drive out of business the risky cryptocurrencies that are being offered privately, which have no such security, and 50% of those have already failed. So the idea if central banks could issue the same sort of service, then that would drive these other cryptocurrencies out of business, and the central bank could once again have some control over the money system. Now, it's interesting that a Swiss proposal of CBDC, the Folgelt Initiative, was voted down in 2018. Sweden seemed to be on the verge of going to CBDC, but has stalled. And China now has adopted a CBDC that operates in parallel with their old money system. And other countries are in various stages of moving in that direction. So one version of CBDCs, a different version than the one I talked about before, namely the retail version, is a wholesale version. And this one would only allow banks to have accounts at the central bank and not transfer personal and business transaction accounts. So this would keep the banks functioning as they do now and represent little, if any, significant change. So my point here is the design of CBDCs is critical. And finally, let me just say a few things about complementary currencies, and then I'll bring this to a close. Anyone can create money. The problem is, of course, to get others to accept it. Many times throughout history, when other money has not been available, communities have come together to create their own money. A prominent example was the American colonies. With insufficient amounts of money from England and Spain to provide the economic needs of the growing colonies, first Massachusetts in 1690, followed by other colonies, all issued their own money. And cities have also issued their own currencies in various ways. And non-governmental agencies have also created their own money. Currently, non-governmental money functions in Kenya as part of the Sarafu network. And a network of local currencies operates in Germany. The best known one is called Chiemgauer. Well, in developed countries, local currencies like Chiemgauer have helped to keep money circulating locally. And I should also mention the Wirtschaftsring Genossenschaft, the Veer Bank in Switzerland, which also is essentially a supplementary credit system, a supplementary money system, and operates on credit. And it's been important since its inception in 1934 for businesses as a way of exchanging credit and doing business together. Well, that's in developed countries, but in undeveloped countries, in undeveloped areas where little currency is available, national currency is available, complementary currencies can be life-giving. As Josh Sidman of the Silvio Gazelle Foundation has pointed out, complementary currencies can be lifeboats for communities when national currencies fail or become unavailable. And these currencies have become more sophisticated in recent years, using blockchain technology and mobile phones as a basis for local payment systems. And people are brought together seeking what goods or services they have to offer. Will Ruddock, the founder of the Sarafu network in Kenya, calls this commitment sharing. There's much more that could be said about these currencies, but just let me say that given the uncertainty of our current financial system globally, and the very real possibility of collapse, how to run local currencies may be useful for our own futures. So in conclusion, just let me say that shifting money creation from the private sector to the public sector would give governments a new revenue source for undertaking infrastructure improvements, both social infrastructure and physical infrastructure. Whether that money creation would be done by the government itself, as in the Alliance for Just Money's approach, or by a central bank, either way. Separating of the creation of money from lending is important. Separating it from lending and from the associated interest burden of lending would accommodate a non-growing economy, a non-growth economy. Also, if all of the interest from lending were folded back into the economy through lending by public banks, wealth would at least, or at least could, be distributed rather than concentrated by the monetary system. So alternatives to the present system do exist and have historical precedents. They're not all mutually exclusive. Both public banks and community currencies could coexist, both with the alliance proposal as well as CBDCs, although they may be less needed with either of these coming into effect. So taking steps toward this is the tough part. It's not easy. Vested interest in the present system will oppose meaningful reform. Reform may not be possible without a crash like the 1930s, when bank reform did occur in the United States. But the groundwork must be laid through education at the grassroots level and in the academic and political spheres. Other reforms, such as in tax law and corporate law, are also necessary to counter the concentration of wealth and power. So people working in these areas are our allies of the people who are working in the monetary area. So we keep working as we can, not knowing how way will open. Thanks very much.
John, does anybody have any immediate comments or questions? Saba.
Yes, thanks, Ron. Thanks, John, for the wonderful presentation. When you mentioned, you showed the diagram of the private money creation as well as the public money creation and it being a public asset versus a public liability. You mentioned that with private money, that it's private money creation is related and bound to the demand for growth. And I'm just wondering how that actually begins to shift in any of the other systems, such that we would, I suppose, also tread more lightly in addition to I suppose funding things that need to be funded.
Yeah, and there's sort of two components to your question. It seems to me sort of theoretical and practical. From a sort of theoretical point of view, one would like to separate creation of money from lending totally, because that's part of the drive. Now, there are various proposals that say, well, what if lending were always at 1%? And there's a proposal by a fellow by Adrian Kuzminski in New York to use public banking in this way, just with 1% as money creation. That would shift things greatly from the current system. But from a theoretical point of view, and that's where we're coming from the Alliance for Just Money, the goal would seem to be totally to separate money creation from the lending process at all, to essentially eliminate this possibility of this continued linkage between money creation and the demand for growth. Any more thoughts on that, Saba?
Yeah, that's helpful. I suppose one of the things that I'm perhaps struggling to understand and to grasp is it seems that there are multiple at least so far, seeming that there are multiple ways in which the demand for growth is had. One that you mentioned through the idea that more money is being created as it's being extinguished. But I suppose my instinct is also that the interest, the need to return more money than was borrowed also plays a role in that. And so if would money creation also happen it would happen essentially without an expectation of return in a sovereign money system, is that correct? How would the
Yeah.
monetary creation or injections happen without that?
I mean, the model is the creation of coinage, which is, it's a revenue for the government in the sense that it doesn't cost them as much to create the coins as the coins are worth in terms of their face value. So now they create these coins, they've got that resource now, and they can in effect use that as a revenue source for their general spending. So that's money spent, not as debt, but it's money spent essentially, you can regard it as a public asset. The government spending on it, at least if it's used wisely for appropriate infrastructure and so on, then it's a public asset.
Any other questions? And by the way, I see there were 3 people who joined us to be on the round of introductions. There's Phil Emmy, who actually is working with John on the book that I mentioned earlier. So he's in the States. There's Ruth Jones from Wales and Jonathan Dale from Manchester in England. So welcome to the 3 of you. So does anybody else have any questions, more questions for John? Susan.
Do I remember that there used to be a public bank or some public banks that were created by Quakers back in the day? That's sort of one question. And I'm wondering also maybe this is a sneak preview of your book, but I wonder if you see a possible role for Quakers, particularly in putting our energy behind one of those 3 alternatives, or is it in educating folks about the dynamics of the system? What do you see is our particular role?
Okay, there were 2 questions there. One is our role now, and then a question about historically. And the early Quakers made a lot of money because they invented good things and produced good products. And so when you have a lot of money, the natural thing is to want to lend it out. And so Quakers got involved in banking very early. Barclays Bank is originally a Quaker bank, as was the Lloyds of London. So the extent to which they are public banks, I think the answer is no, they weren't. They were private banks, essentially. But private corporations can be run in ways that are either good ways or bad ways. They can be run in ways that focus only on profit or focus on the benefits to society and their customers. And I think Quaker businesses undoubtedly paid attention to the latter, but they made good money too. So that was the role. It's described in Mike King's book, Quakernomics, so you can read a little bit about it there. As to our role today, I think that it's important that we speak truth. And what we have seen is that there has been essentially an effort to conceal this fact that that banks create our money. For instance, back in 1964, the Federal Reserve actually published a piece that said just that. They confessed it. And then it was withdrawn. because they didn't want to publish that. They wanted, and it turns out that the banking establishment has basically controlled the economics profession. So the economics profession essentially don't talk about how money is created. It was very interesting when I went in to talk to one of our local bankers, who's a nice guy. And I asked him, about this business of his bank creating money. Oh, he denied it, absolutely. And explained to me what his view of it was. And I said, well, where did you learn that? He says, well, in my economics course. So he was unaware of the fact that his bank was creating money every time to make a loan. He wasn't dishonest. He had just been misinformed by the system. The control of information has been so extensive to be able to do that. So education is important at the grassroots level at this point. And it has to be education at levels that are grassroots and in the academic world. And that's happening because more and more publications are now coming out by people at very high levels academically, essentially conceding that the present system is unsustainable and unworkable and it has to be changed. So there's some very good people. Soleh Omarova is one, Robert Hockett is another, Christine Desan is another. All these people have been involved in exploring how changes can be made to make the system work for us instead of just leading us to disaster. So I think we have an opportunity within our own Quaker meetings to educate people. We have an opportunity then to speak to other groups as way opens for us to participate in this educational process. And there's, in Britain, there's positive money. Many of you are surely familiar with positive money. And positive money has done a lot of good work. Their support has now pretty much gone to trying to get the Bank of England to act like a public bank. And you asked about the idea of, well, which one should we support? I think it's going to depend on the socio-political context of where you are. In principle, Central Bank of England is owned by the government of England, and the same is true of Canada and a number of other nations. It's not true in the United States. Our situation is a little bit different. So I think which one to promote may depend on sort of where you are and the circumstances that you're dealing with. So it's hard to give a blanket answer to that question. Yes, Stephen.
Right. In fact, central banks, certainly in UK, with quantitative easing, created account money and bought government debt on the secondary market in order to launch it. So they already do that. They're perfectly aware that they can create money. As positive money and as a commentator, sorry, names are going. Richard Murphy points out, and the modern monetary theorists point out that government spending is always, in fact, they present the checks to the central bank. The central bank meets them, and then governments then need to decide how much they need to tax out of the economy, not to prevent inflation. And it's more that way round. Sorry, that's two points in one. But yeah, I think I'll leave it there.
Yeah, well, my view of modern monetary theory is that it's really not a proposal for any reform. What they basically argue is, I think, as you suggested, Stephen, that essentially governments end up creating their own money, whether it's direct or indirect, and so they can never run out of money. So you shouldn't worry about debt levels. I find that troubling, and the fact, because strictly speaking, the government, at least our government, it doesn't create its own money because the central bank is separate from the government, and it has to go into debt in order to get that money from the central bank. So that's a very different situation than if the government were simply creating its own money without going through a bank to do so. So that's the difference in the system. So what I read from Stephanie Kelton and others in MMT is that they aren't challenging essentially the role that banks currently play. They are instead simply saying, government, go ahead and spend money and solve these problems that we have, solve the environmental problems, solve the medical problems, solve the educational problem. Go ahead and spend, don't worry about it. But there's something very troubling about that. And of course, what happened shortly after, for instance, Stephanie Kelton's book came out, we had the increase in spending that did occur with COVID. And the MMT has always argued, well, the limit should be inflation. Well, as soon as the government started spending after COVID, sure enough, we got inflation. And so I think that tempered some of the enthusiasm for MMT at the point at that time. But I think we have to look beyond that to essentially what the banks are doing. That has to be a fundamental part of the reform in order to deal with this issue. Thanks, Stephen, for your question. Go ahead, Phil.
Yeah, I just wanted to make a comment about the issue of quantitative easing. Yes, the Federal Reserve does create money in the process of quantitative easing. What it does is it buys bonds from banks and gives them cash, which they then use as reserves. This process is not a cost-free process, as would be public banking or the kind of banking proposals that you've otherwise mentioned, John. So I just wanted to make sure that we were aware that when the Federal Reserve does that, it increases a debt on its own account, and so this is not a cost-free exercise. Well, I think it's important to remember, John, that there are really two strong examples that need to be kept in mind. And one is the situation with the American colonies, where the colonial assemblies essentially lent money into the local economies. They weren't particularly interested in getting the principal back. They liked the interest. And the interest was then directed toward the creation of all kinds of public goods and services, which really helped the economies of the colonies prosper. And that is the case of the National Bank of Canada, which was established in 1934 and nationalized in 1938, and then was able to interest-free finance Canada's participation in World War II, finance the Transcontinental Highway system, the St. Lawrence Freeway, the public health system, their pension system, their system of universities and colleges. And they did that without adding substantially to the federal debt. And then that practice was given up at the insistence of the Bank of International Settlements in 1974 during the conservative government in Canada. And since then, Canada has been borrowing from private banks, and its federal debt has exploded, just as ours has. So these are two examples that need to be kept in mind to help understand what can be done when the government prints its own money, and what happens when it fails to do so. Thank you.
Thanks, Phil. Wendy?
Fairly straightforward question. You've told us a lot, too much for me to take in. And I'm wondering whether the book that you've got coming out, sorry, your group, I forget what it's called, whether that will cover what you've been talking about, and when it will come out, whether it will be available over here. I'm thinking of the like Quaker bookshop in Friend's house, but what its availability will be. Thank you.
Yeah, I think our hope is that is published as part of the series that the Quaker Institute for the Future has been publishing, because they've already published 3 volumes that essentially point to the problem of money creation and the monetary system. But essentially those books did not explore further alternatives and so on. So what our book is intended to do is to take that issue and lay it out in greater detail so people can understand the basis for taking positions and the basis for advocating one kind of legislation or another.
Jump in
You know-
here. Did I hear Phil say a few minutes ago imply that it's the Bank of International Settlements that is the big stumbling block here? And if we look at what's going on in many European countries at the moment, the big political crises, both well, especially in France right now, but also in Britain, on the question of debt and the fact that the notation agencies have downgraded the French debt. So the interest rates go up, and therefore the debt, the payment of interest in the government balance sheet skyrockets. And this is what's brought down 2 French governments in the last 12 months. But how do we get around this? And then I see Charles' hand, but maybe you'd like to take that question first.
Well, you know, I mean, there are models for these things in the past historically. When governments have been essentially destitute, whether they're city governments or other units of government. But one of the stories is the Isle of Guernsey in the 1800s, which found itself at the end of the Napoleonic Wars just without resources. And so basically what they did is they decided, well, they would create their own money to hire their own people to do the building and pay the people who could supply what they needed, and it was all available there. And sure enough, it increased then employment and really achieved prosperity and part of this business of money creation was a part of that. So it seems to me that is a model that any country could essentially could follow. The opposition to that, of course, comes from the banking establishment, which does not want to see their monopoly on money creation be dissipated. I mean, it was the global banking industry, which is probably Wall Street and London mainly, that operated through the Bank of International Settlements to get Canada to behave like they wanted them to behave, and ended that direct lending. You know, if you have a central bank that's lending into its own economy without expectation of being repaid and not charging interest, that's essentially a grant. But banks aren't set up to do that. So will banks through central bank actually be able to do that as in the same way that a government could do in terms of creating a supply? So that's a question. People argue that central bank can do this because they can basically lend to the government and not charge any interest, and not even demand that there be a repayment. So it's an interesting point. But Charles would like to get in here with a question or comment.
Yes, please. I think you've answered part of it. My question is whether we could make the current system better without actually introducing a new system. I understand that there are limits on the amount that banks can create, sort of capital sufficiency rules and things. Perhaps we could tighten those so that we're not so dependent on growth to sort of keep the system running.
Oh, yes. And of course, that's what happened in the 30s, in a sense, during the Depression, when the Federal Reserve Act was in the United States was modified greatly and was introduced. Oops,
Can you
Oh,
turn
well,
off your mic? Yeah, thanks.
he's got it off now. Right. So basically things were tightened up then simply through regulations. But you can see what happens when it's done by regulations alone, and that is the establishment, the economic establishment, has enormous resources to find ways around those regulations, and then has enormous lobbying influence to essentially loosen the regulations. So the idea of going back through regulations again doesn't seem like a fundamental enough change in order to get where we want to go to achieve sustainability. So I think the goal has to be farther than that. But you're right that some of that could help, just like it did help in the 30s, of greater restraints on banks. And one of the proposals that's done by Omarova and Hockett have both somewhat similar proposals, and what they have essentially is to say that, well, everybody ought to be able to shift their accounts over to either to a central bank, or in case Hockett's argues simply to the Treasury instead of a central bank. But the point is, what that would do is to take money away from banks. That is to say, people would take their deposits out and put it in the government or the Federal Reserve or whatever. And that, in a sense, would greatly limit the ability of banks to lend. So that has a way of controlling the system. And as I mentioned in the talk, there's sort of two ways to think about that. One is that the banks, the central bank could allow the private banks to continue their lending simply by providing deposits, that is to say, lending to the private banks, and that would let the private banks keep lending. And with that, this credit guidance could be applied to stop the speculative lending that they do now, and channel that lending into productive things that will help us survive. So that's one channel that could be done. Right. So that's sort of a gradual shift of the system, rather than the legal proposal that we have here to change it with a single law, and that's hard to do.
Pamela has been unmuted for a long time. Pamela, did you want to come in?
No, I just never muted. I think John's doing a great job. I'm thrilled.
Well, Pamela, you've been an inspiration to me, and what you've written has been all helpful to all of this, right?
In your talk, John, you made some reference quickly to the values, principles, policies, and paper that we have on the table at the moment. Do you have any specific suggestions as to what might need to be changed or added in that?
Well, some of the things in here, I'm looking at it right now, and I highlighted some things when I read it, and some of the things, in my view, don't go far enough. But that's all right, because it's all right to go stepwise. For instance, you have restrictions on speculation in stock and commodity markets by banks. And that's just what we've been talking about. The idea, how do you do these restrictions? Well, can you do this by essentially having the money, having deposits transfer out of the banks? So now you've got a way to control the banks through credit guidance by the central bank. So that's a relevant statement here. And my own thinking is that well, I'm idealistic, and I know I'm idealistic about this. So I hold this view that no, we should do the complete transfer of control of the money system from the private system to the public system. That's the goal. But how we get there is going to be more complex, and these stepwise proposals, I think, have to be honored for their value, and perhaps that will be a way to actually move forward. But that's about all I can say. I didn't think about that question because most of the things that you have in here, I just read and said, yeah, that's right. Yeah, that's right. Yeah, those are the issues. You've really done it well. I love the statement here, limitations on the accumulation of wealth by individuals and corporations. I think that is absolutely central. And the monetary system, has a role in that, but that's not the whole story. There are other legal changes that have to be undertaken too. In corporate law, for instance, corporations have far too much power, and that can be changed, at least in the United States, by simply start that change by reversing the Citizens United decision, a single court decision. And there are other steps that can be carried forward as well. Ruth, unmute.
Good evening, friends. What I'm sitting with is the sense that we're talking about what we can do in time. And I'm just wondering what the feelings and responses are to today's announcement from the Bank of England chief, who warns of worrying echoes of the 2008 financial crisis. The governor of the Bank of England, Andrew Bailey, has warned recent events in the US private credit markets have worrying echoes of the subprime mortgage crisis that kicked off the global financial crash of 2008. So my question is, do we have the time that you seem to be assuming to make these changes? And what changes do we need to make quickly?
I just add to that, perhaps you refer, Ruth, to the come out from the Bank of England, but I think it was only yesterday or the day before there was also a statement out from the International Monetary Fund, the IMF, which was looking at the global situation and the trade wars that have been going on at the moment, and they're raising similar concerns. So, John.
Well, I've felt for a long time we're headed for a crash. So these statements that are coming are I'm just saying, yeah, they're right. As far as what to do about it, I don't think there's anything there's anything that I know of, at least, no sort of political handle that can make the changes that need to prevent what's going to happen in terms of this crash. I'd love to be able to convince all our Congress to say, time to change the way we do our money and change a number of other systems as well. And we keep writing letters to that effect, but it has no perceptible consequences as of yet. So I have to think that we are going to have another severe depression, and we will have to think about how we are going to adapt to the situations that we are faced with, and how we are going to, in those circumstances, figure out how to continue our efforts, lobbying or otherwise, to restore a system that has a better foundation. I know that's not much of an answer, Ruth, but that's as best as I could do. Okay, well, Pamela.
Well, one other way of thinking about it, John, is what you mentioned earlier about complementary currencies arising in times of chaos and need, and it might behoove us all to learn about those models and think about ones that might be able to be applied locally, kind of to kind of build up our muscles in that area as we try to make those larger changes, which are really, really big and hard to make.
Yeah, thanks very much, Pamela, for saying that, because I fully agree with that there is a role for these local currencies that is going to play a role in our lifetime. I'm 85. I thought this all stuff was all going to happen after I was long gone. I no longer think that's the case. And so the whole idea of learning of taking advantage the information that has been gleaned by Will Ruddick and so on, operating in Africa, and the German regio system, which is a whole community of local currencies. We can learn from these existing processes and be prepared to set up our own as way opens under a set of circumstances that we may find ourselves in. So thanks, Pamela. Yeah, Phil.
I always thought it would be interesting to see established a interfaith fiduciary trust, essentially a bank that would be owned by a foundation, governed by a collaboration among a variety of faith communities, so that any profit that was generated by the operation of that bank would then be allocated to a variety of, how should I say, charitable projects. And this is a model that's actually a rather old model, where a bank is not owned by investors, but is owned by a foundation that has philanthropical interests and activities. So that would be one thing that could be promoted. It would put us in a position where we would be able to carry on under a situation of duress.
Just ask Phil, would that be like a local enterprise, or would it be a national, or what, at what level would that bank operate?
That would depend on whether it was chartered nationally or by a particular state. I think that's not so much the question as whether such an operation could gain rapid traction among a variety of faith communities, have the faith community members divert their banking activity toward that entity rather than commercial banks, and would depend on how rapidly it would grow in size.
Yeah, I think that would be interesting to take that conversation, Phil, to Ellen Brown, in the Public Banking Institute, because in a sense, that's a type of public bank that's not government owned, but one that would face the same kind of obstacles that the Public Banking Institute finds itself facing with regard to the difficulty, given existing law, of setting up a new bank. The number of banks have been decreasing over time. It's tough to set up a new bank. There are all kinds of regulations that make this difficult. So that's a reasonable way to inquire. And I think we could learn from the public banking people more about their experience with that. Susan.
Some months ago, Ruth Jones had given a really powerful presentation about looking at the economies from the standpoint of Rwanda and other peoples in the global South. And I'm just wondering if you have seen discourse or proposals that are particularly geared to protecting the global South, I mean, to be sort of generalized, from a 2008 kind of crash or 2029 crash. We all are concerned about our own bank accounts, but the people that are going to be most affected, to the standpoint of starvation, I just wonder if there's discourse around this. Are there problem solving going on? Are there books being written? That's all.
Well, I think Pamela just put in the chat the reference to the Will Ruddick's project in Kenya. And I think that's the one that's best formed. And that came out of a poverty condition. It came out of the Mombasa slum. is where they started that local currencies. And so that's a model for helping impoverished areas utilize what resources they do have to prevent them from being drained any further, and to use what they have to be able to achieve some degree of prosperity. So I think you're right that there's a real concern for that, and those systems that Will Ruddick and others have been developing for those communities may provide really vital information and modeling for us to use for our own future. Yeah, Ruth.
I'm just responding to what Susan said in a rather wry way. I'm wondering why you think that we're not as vulnerable to hunger as people in the global south. I'd actually question that. We are not food secure, and we are very dependent upon our economy to keep going. The people that I'm thinking of in the global south will continue to eat and self-organize into small lending circles, because that's what they already do. But I think we're really in danger of underestimating our own immediate vulnerability and how fragile our dependency is on the banking system as we know it. And as John said, so many of our delusions about wealth are pinned onto spreadsheet numbers, and that actually has no reality in a meaningful sense. It can all just disappear, and may well do very soon. And we do not know how to feed ourselves. Sorry to throw that in, but I'm just very aware that we can talk about these things and sort of transfer the concern to the global south. But I think the global south, there are plenty of very wealthy people in the global south, but people who have remained in a more subsistence economy have less far to fall. They're already more reality-based in their survival skills than we are.
Yeah, it's just like during the Depression, people in cities had difficulties. People who lived on farms still ate.
Well, to reality, I was struck, in fact, John, when you mentioned local currencies. You gave the example, I think it was Kenya, which is blockchain based. Made me think immediately of some of the better known local currencies that did exist in England and Europe. The Totnes pound, for example, it went out of business a few years ago because people were no longer using paper to pay. Everybody wanted to be able to pay with a credit card or their telephone. And so the Totnes pound went out of business. So it's interesting that Kenya has developed its own equivalent already on a blockchain basis. Pamela.
Well, just in response to that, the Chiemgauer made a really big leap forward when they moved from paper money to digital money. So there's an indication, like sometimes people who are maybe farther behind technologically speaking make a leap that the rest of us have to catch up with. But I was thinking about the macroeconomics of the question about disparity between wealthy nations and poor nations, and just wanted to remind us of the debt jubilee project at the turn of the century, where I don't know how many billions of dollars were just written off the books for 37 poor countries, and nobody blinked an eye. So a lot of what's going on in countries that are, were colonized is, just their national income is being bled to pay debt, and So debt jubilee doesn't solve the problem. It kind of brings it back to then the need to address the kind of things that John has been talking about. But it would be, I think we need to have it in our minds as something to be talking about, and it's certainly something that religious people can talk about.
We're getting close to the end of our hour and a half together. Does anybody have any further questions for John or thoughts of their own?
Curious as to whether any of the large Quaker organizations are taking a stand with regard to these monetary issues, and also whether you've had maybe some response from them with regard to the Quaker Institute for the Future. Is there
Right.
anything
Well,
to build upon?
yeah. We're interested in getting the Friends Committee on National Legislation educated essentially about this issue, so that when issues come up, I mean, they were in no position whatsoever to offer any advice with regard to the passage of the recent Genius Act, which essentially gave national blessing to these stable coins, which are privately issued coins, digital money, of course. And so FCNL was in no position to be able to respond at all, because they just haven't yet done the homework. And that's what we'd like to help FCNL do, to be able to respond appropriately when these issues come up, is if they can see them as part and parcel of their fundamental commitments to peace and social justice legislatively. So that's a challenge for us to work on, and people have been trying to do that with FCNL. FCNL is not a sort of out front organization because they deal with the legislature, and so they have to maintain their ability to communicate with legislators across the political spectrum. So, but they need to be educated, and that's what some of us are trying to do. That's what we hope the book will help do. Yeah, Pamela.
Yeah, I don't know, but I wonder if some of the Quaker groups that are involved with UN efforts might be the farthest ahead on these issues. Although actually, Britain Yearly Meeting is doing better than most of the folks in our country, so far as I can tell.
The Quaker funds that I'm aware, well, some of them that I'm thinking of are actively spending down at the moment.
Yeah, the rationale being, I suppose, if you're looking at a depression and you know that the values of those things are all going to fall, why hang on to them?
And also that the funds rely upon generating interest, and they traditionally have spent the interest, and that is part of sustaining the current system in ways that we can question the ethics of that.
Yeah, that's a funny question. I mean, it's come up in our meeting too. You know, we have some money, and we got to deposit to maximize our return, and that's, of course, is exactly the nomenclature of the economic system. We want to maximize our return, and something feels uncomfortable about that. But if you've got a choice to put it here or here, and you get this interest here and this other interest here, you know, there is a tendency to want to go with a higher interest rates. And obviously, the whole ethics of investing is to try to look to see where that money goes once you lend it. And that's sometimes hard to figure out in many circumstances, where the money is going to go. I mean, you put your money in a bank, you don't know where it goes. It goes wherever the bank wants to put it. So those are difficult decisions. Well, I'd actually like to scoot because I've got a meeting in 5 minutes at the meeting house here of the Peace and Social Concerns Committee that I'm supposed to be going to. So if there are questions, I don't want to cut this short because this has been a treasure. Thank you so much for this sharing. I've really enjoyed it and enjoyed the conversations, and I hope that I hope this is a value to your broader efforts that you've made in terms of the whole economic system, to be able to bring this monetary thing in as part of it. But you have a broader view, and that broad view is absolutely essential.
Thank you so much, John. It's been really wonderful. I really appreciate it.
You, everybody. So with that, do we just take a few minutes silence?
Good idea.
And you leave when you have to, John.
Okay.